Hey guys, welcome to another video on the Fire Me channel. Today we're going to be talking about bulls, bears, and pigs. What's the difference? And we actually even have a bonus animal for you. Alright, so let's get started. So bulls, overly optimistic. So poor earnings reports often viewed as one-off events. They are not viewed as significant problems, and that the company will, next quarter will be better. And overlooking serious problems in the organization is a fairly common characteristic of someone that's overly bullish. And one of the biggest problems with being a bull is the reluctance to sell after they've made a healthy profit. Maybe they're up 50, even 100% on investment, and they just start thinking that it's going to go forever and they won't take a profit because they want to keep riding the investment. Now, another issue with the bulls is they'll often ignore headline risks and Fed data warning of an economic slowdown. So there's always a reason why things could keep going on, keep getting better, keep improving. And the bulls really don't want to believe that anything bad can possibly happen. And whenever there is a drop in the stock market, they view it as the opportunity of a lifetime. So on another YouTube channel, actually, there was a fairly popular one. A guy had General Electric as a fairly substantial holding, and when it dropped to $15 at the time, he was telling all of his viewers what a deal of a lifetime this was. Get in, buy it now, huge dividend, etc. It wasn't that much. A few weeks later, I believe it wasn't that very much longer, and the dividend got cut to a penny. Stock fell through the floor, but this was probably one of the classic examples of being so bullish and so overly optimistic. It actually tanked the entire portfolio for himself and his viewers that had that stock. So you really got to, if you're a bull yourself, which I tend to be, you really got to keep yourself in check and give yourself a reality check once in a while to make sure that you're not overly optimistic when things maybe really aren't that good. And the other tip is you got to be careful of catching falling knives. Now, this is a term you may have heard on some of the investing shows on CNBC and whatnot. But what a falling knife is basically if you have a company, it could be a very good company, and the stock price is falling, and you keep thinking, oh, this is as bad as it can get, and you keep buying it, and you keep buying it and keep buying it, but the stock keeps tanking and tanking and tanking. Now, a bull will often spin this as I'm lowering my cost basis, or I'm cost averaging lower. But you're really catching a falling knife, because this thing is going to hurt you on the way down. You're trying to catch it before it hits the bottom. And bulls really need to be careful of this. This is one of the traps that a lot of bull type investors fall into. All right, now the bears. Now, bears are the ones that are pessimistic. And they're often the people that'll sit out of the stock market or will sell it short. Most retail investors will just choose to sit out because they don't sell short, or they won't get the margin to sell short. But it's really the pessimistic or negative view on things. And anytime that there's say a shortfall in earnings, or negative in the negative earnings, or never quite met expectations, the sky is instantly falling. This company's going broke overnight. Things are as bad as they're ever going to be. Even if that's not the case, there's lots of classic examples of when maybe a company has come in a little weaker than originally forecasted or guided for that quarter, and then the next quarter they come roaring back. That's when the bears get hurt, is when they're overly pessimistic on some of these things. And yeah, so the next point here is people that are pessimistic, or the bears, are usually more worried about losing money than they are about making it. So they really focus on risk avoidance, or avoiding anything that could lose them money, and they only want to buy something that's going to make them money, which, as you know, if you're an investor, There's no guarantees in this. It is always just, you're always just one wrong decision from losing money, but the bears are very, very worried about losing money. Now, when bears are right, they can make very, very big gains in a very short period of time. So if you were selling General Electric short, for instance, when it tanked and when they cut the dividend, you would have made a boatload of money. However, just as a general investment rule, the stock market over time always has gone up. So if you're someone that's constantly selling short and negative on everything and wants to make money only by selling short and not investing for the long term, chances are you are going to end up losing money in the long run. The S&P 500 has, as everyone knows, has gone up and to the right for decades on average. I think the average return is 8 or 10% annually, somewhere in there, for the S&P 500 over the last 50 plus years. So if you're a constant pessimist, you will end up getting burnt on this eventually. Okay, so the last point I had, which I can't remember what it was now. Yes, so this was long term. It's hard to make money as the markets typically go up steadily. So that kind of falls in line with the last point I was making about if you're a constant pessimist, chances are you're going to end up losing money. All right, so now what is a pig? So a pig is someone, usually a bull, but it could be a bear as well, and but you just get greedy. That's really what it is. So you've all heard that saying, bulls make money, pigs make money, you've all heard the saying, bulls make money, bears make money, pigs get slaughtered, and that's probably the truest statement in investing that you'll ever hear. It's simply out of greed. That it's just never enough. No matter how big the gain on an investment, it's never big enough for these people. And the other thing too that makes people pigs is they just don't want to pay the tax. So if someone's up 100% gain in their portfolio and they want to take profits, but then they I don't want to pay the tax man, so I'm not going to sell my investment. Next thing you know, the investment gets wiped out and now they have zero. So it's really a good idea not to be a pig. Have price targets. Know when your entry points are, know when your exit points are, and stick to your rules. Don't try to hit your price target and then be like, you know what, I'm going to hold this a little longer because you're getting greedy. You will end up losing money. Almost inevitably, sooner or later, you will get burnt by that. The other reason why people end up being pigs is they like to watch their portfolio grow with unrealistic expectations about future growth. So if you were in a stock like Amazon right now, and say it gets up to $1,600, $2,000, you're not going to sit in that stock and make a double on it from that point. The time to have made a double was 10, 15 years ago when it was cheap. It's going to be a long time before you make a huge gain on that, but there is a lot of downside risk when you start getting valuations that are that high in a company. And when I say valuations, I don't mean stock price, but the actual valuation of the company itself. It's really hard to make exponential gains from there. And the other thing with pigs, now this point I want to bring out, pigs never take profits, but they always stick around for the losses. Now this goes back to our first point of being greedy. Too much isn't enough, and they don't want to sell property taxes. So a pig never wants to take their profits. They want more and more and more, and they always ride it to the bottom. I've seen it a million times, and it's actually disappointing because you see some people with huge gains and then they just ride it back to right where they started, or potentially even to losses. And when they do ride these onto the bottom to the losses, they always think the market's going to rebound and that they are going to be able to resell at previous highs. I can think of a handful of examples off the top of my head. If you guys remember a company called Nortel, that company was skyrocketed. It was one of the first big tech companies I remember that took off to the moon, something happened with their, I don't know, I can't remember now if it was their technology got outdated or whatever happened. Company tanked, it went to the bottom, it never did recover. Yeah, it was a disaster. So if you are a pig and you never took your profits, you stuck around for the losses, don't expect that that company is necessarily going to rebound where you're going to be able to sell back at previous highs or even break even in some cases. Now this was our bonus animal, the sheep. So why a sheep? So what do sheep do? Well, they get slaughtered just like the pigs, but for different reasons. So sheep, they get slaughtered not because they're greedy, but it's because they follow the crowd. So they're always late to buy and they're always late to sell, and that's just the way it is. So classic example of this, Microsoft, Apple, they had a huge run. People that hadn't been bought in, they're like, oh, okay, well, it's been doing so well for so long, I'm just going to buy in. They don't really know the fundamentals, the story behind it. It's just, they're just following the crowds. And when you do that, you're always late to the party and you're always the last guy to sell. It's not going to be good. And here's one of the key points. So they do not know why they are in the investment or what the company's even about. They are just there or buying into this business because someone else has, and they want to be in it now as well. And they don't know anything about the business that they've invested in. They don't have a strategy or goals for that investment. They just bought it because someone else did. And a lot of times sheep, their investment decisions are determined by emotions versus facts or the numbers, and they just kind of do what everyone else is doing. But because they're late, more often than not, they end up losing a bunch of money. So that is the 3 animals, and the 4th bonus animal. So pigs, just if you take anything away from this video, guys, just remember pigs and sheep get slaughtered. Be a bull, be a bear, but do not be a pig, and definitely do not be a sheep. I would say a sheep is as bad as being a pig. So anyways, hope you guys have enjoyed this video. Give the video a thumbs up if you liked it. Remember to subscribe, and we look forward to seeing you in future videos.